Okay, cool. So we're gonna get started now. So a couple of housekeeping things. So I have a slides. These slides they're available right now. You can download them at the link directly kind of there at the bottom, foresight.is/cap/slides. We'll also be doing, I have like a very simple sample spreadsheet example that we're gonna use. That's also available online, but we'll get to that later via link. This session is gonna be recorded and I'm gonna put the recording will be available later as well. So first off, thank you everyone for joining. I'm really looking forward to doing this. I'm really looking forward to doing kind of more webinars around this content. I help people and founders and VCs with this kind of stuff every single day. And I'm just generally been excited about teaching more people about how to do it. And so my goal here is to kind of go through a set of kind of content around kind of the basic kind of foundational knowledge in terms of like how to model cap tables. And then I really do want to leave some time available for questions that people want to ask. And so a little bit about me first. So I'm Taylor. Again, I live in Pittsburgh, Pennsylvania. I have a bachelor's in economics and MBA in finance. And I've done a lot of different things in my life. Used to work as a venture capitalist in New York, worked in the EIR or investment residence at Venture for America, run product for an e-commerce company, worked as a consultant, worked in private equity, used to work as a professional photographer. But for the last 5 years now, I've worked on Foresight full-time. And so Foresight is what I call like a boutique product and services company where I build products and services for founders and investors to do forecasting for startups and venture funds. Most of what I do is with startups, but I also work with a lot of emerging managers in creating models for their funds and then helping them through all of this same sort of kind of topic area as well. So I've done financial modeling essentially my entire life. I've done Foresight full-time for the past 5 years. I did it part-time for probably a decade prior to that. I've been building models with startups since 2000. So it's been quite a long time. And the reason why I care about financial models is because they're not always right? And I think that there is a common narrative around models aren't right, so they're not useless. And that's actually the kind of wrong way I think about it. Models are structures for helping us make critical business decisions. They're not answers in and of themselves. They're structures for help us to evaluate and analyze situations. And if you use it as that tool, they can be tremendously powerful. If you think about building them purely as, hey, this is the answer, that's when it kind of falls down. So the key is to kind of understand kind of the concept behind them, kind of why they're valuable and important. So the objectives for today is I want to do like a basic understanding of how to model cap tables and what matters, run through some of the typical terms that you'll see in the structures on cap tables, and then run through an example tool which we can share. And so one of the hardest things of doing a session like this is basically, we can go incredibly in depth. And so the hard thing about this is finding the right set of content that we can cover within a fairly short time period across a wide variety of skill levels and backgrounds. Some people here probably built tons of cap tables and are very experienced in this space. Some people probably have very little idea. So finding a balance between them is often really difficult. So things we are going to cover, I do want to talk about how to kind of raise capital by selling shares of equity, kind of how safes and convertibles impact cap tables as well, and how to calculate kind of basic kind of share prices and understand the difference between issuing outstanding kind of fully diluted and pre-financing and post-forma cap tables. That's kind of what I want a basic level understanding, foundational kind of knowledge to get across. What we can't get into is like really detailed like legal strategic questions in terms of what's the right way to raise capital. Can't get into like converting convertible investments, option pools, warrants, pro ratas, anti-dilution, recaps, token cap tables, valuations, extra waterfalls. Those are things that are kind of outside the scope of kind of what we can cover today. If you have questions about these things, I'll tackle as much as I can in the Q&A session. And then I'm always able to or happy to answer questions if you want to ask questions later on. Happy to do that later on. So the thing about cap tables is that I've been doing this for a long time. When I first started doing this, I sucked, right? So one of the first times I put together a cap table was in 2006, and I put together for a company that I was working for as a part-time CFO. And I put together a cap table around a proposed round of financing to send to their investors. And basically, the investor was kind of nice in saying that I was completely wrong, and that I calculated everything completely wrong. And I had to kind of listen to and talk to and kind of learn a lot more about that. What I had is like, in my specific example, what my basic understanding was is like I tried to use the percentages and calculate things from them, which is entirely the wrong way to do it. And so ever since then, I've been spending progressively more time in terms of learning the nuances and mechanics of these things, and then try to also understand as I can explain it in a simple way. So it's something that I've been working on for a while. One of the things that I have released is a tool, which some of you have probably seen, is a spreadsheet you can be available to download on the web. It's for free, and it's meant as an educational tool, like not a tool like manage a cap table for a growing company, but an educational tool to understand how the mechanics of modeling cap tables works, with a bunch of different examples of how to do certain things. So, and this is something I have evolved and updated a lot over time, and we'll continue to update, and probably will have a release coming out the next month or so of a newer version. And the major thing about this is there's so many ways to do cap tables, and there's actually tons of different examples, other examples of how to cap tables. If you Google or look on the web or go to eloquence.com or whatever, there's tons of other examples out there, and that's fine. There are many, many ways to construct them. The way I kind of present and talk about it is one way, but there are many ways to do this. And this is one reason why I think it's really important to understand the mechanics of how that works. You can understand different approaches, different structures out there. There's also a lot of tools, web apps out there for modeling cap tables, and they're incredibly valuable. Carta, Legi, Pulley, all these ones are great services for managing cap tables for growing companies. I also think it's still really valuable to understand the basic mechanics and so you can do analysis and simple spreadsheets to understand how things work kind of outside of those tools. So basic terminology and to basic kind of terminology and structure here. So there's effectively I want to cover like 3 different structures that are commonly used to raise capital. And so we can set the terminology correct so we understand kind of how it kind of lays into a cap table. First one is equity, and that's very simple. Equity is really a price round, and that reflects selling shares at a predetermined share price with a valuation of the shares. And calculating the valuation of shares is in general fairly simple. Take the pre-money valuation or the valuation that you decide on to be the value of the company before new money comes in, divided by the number of shares that are issued outstanding plus options. That's price per share. Now there are complications that come into that around conversions and other things, but in general, that's kind of a simplified way of thinking about it. So it's fairly straightforward usually to calculate that. So notes work differently. So with equity, money comes in, you set a price per share, you issue new shares to new investors, and there's a number of shares, a cap table of the number of shares each one's own. There are 2 other structures, convertible notes and safes. It works a little bit differently, right? These are have the rights to convert into equity, but they don't actually own equity or shares yet. So I'll tackle convertible note, historically like pretty popular. It's debt, debt that has the right to convert equity at some milestone, some event, sometime, and it's typically treated as unsecured debt. With a very seniority and rights and repayments associated with kind of debt. The 2 common terms you find with convertibles is around discount rate, cap, and interest rate. Basically what that means is you agree to a right for the amount of money you put in to convert into shares at some future point in time, and you set a couple of terms to say, okay, well, how am I gonna convert that into shares? Typically, the whole point of convertible note is they're offered at a discount to what the next round of financing is to compensate people for putting money in earlier. And the way of calculating the degree of which they get compensated for that is usually through a discount rate, basically saying, hey, if the price per share is $1 or the other one, then I get to buy my shares for less than $1. And that's usually done through either discount rate or a cap, which is a max valuation of the shares you want to pay. Convertible notes usually have an interest rate. So an interest rate that typically is like accrued over time and not paid, but then can often be converted into shares of the company as well. One thing that can often go, a little side note, like one time it often confuses people about the discount rate is that in most legal docs, it's not written. If you agree to a 20% discount rate, legal docs never say like there's a 20% discount. They usually say you can buy it at 80%, purchase at 80% of the equity price. Small little thing, but important, like little small thing to kind of know and understand. So over time, we built up a couple of other basic structures used for this. It's safes. And there's effectively two main types of safes. One is a pre-money, which is essentially treated as a warrant to purchase shares, not treated as typical debt. And it was created to be simpler and easier to do, more standardized, to reduce the legal costs and complexities, and handle a couple of things associated with notes that investors and founders found to be a little more difficult to handle sometimes. Can have caps or discounts, usually not have interest rate, does not have a maturity associated with it. Y Combinator introduced it in 2013 and released standard docs that tons of people used. And then a few years ago, they updated them with a new kind of safe called a post-money safe. And again, this is another introduced by Y Combinator. You can download the docs and read all the details associated with that. That I've actually provided in the documents that YC has will tell you, like, hey, here's exactly how you use a post-money safe. Here's how the calculations work, all those sort of things. It's very clear in terms of how to use them. And these were introduced basically to provide some clarity, and they provide a lot more clarity around conversion methods. And so the pro rata rights were removed from it, but they created like side letters can be attached to them to create that. The goal of this was to provide more clarity around the ownership that was often not handled in pre-money safes and convertible notes that are more commonly used. Post-money safes are more common at this point in time. From that, but that said, there are still valid reasons in terms of why people would want a note or equity or safe, and then the right instrument to use for it kind of varies on the situation. The common terminology we use around this is the idea of like raising a round. So raising a round just means you're taking in investment capital using typically like one of these structures, and you give them securities at the price. Now, rounds can be, I say the word like amorphous, meaning that not every single like money you put in is like a round per se. You can bundle groups of rounds or notes or safes or things together to constitute an overall round. It's very common for a company as it's raising money to issue multiple safes at different valuations. They're not, each one's not their own round, like they're all kind of combined as part of it. And they're typically aggregated as a round when it comes to the actual kind of conversion point. And so, a round can be one specific financing event, or it can be a number of safes or notes or things that were issued over time. And it comes down to really like how someone wants to communicate, how they want to communicate their fundraising story is the most important part to it. So a cap table is one way in which we communicate the numbers behind it. So a cap table is a capitalization table. A cap table, it's a list of securities that are issued by the company and a list of who owns them. So we typically think this in two structures. One is a pre-financing cap table, and one is a pro forma or post-financing cap table. Both of them, they focus on issuing the different class of shares. The major difference is the pre-financing says, hey, here's what everyone owns right now. Pro forma is what it's gonna look like after financing. The example I actually have here is one really good way to kind of lay out the financings. This is done by Fred Wilson a long time ago, but still very valuable. The link there still works. You can download this spreadsheet and all that sort of stuff. What's nice about it is you can see, the number of investors going down in rows, and then across in columns, the number of shares each one owns. And because investors can purchase shares at different rounds, it actually was going to say the number of the amount they invested, the price per share, and the shares that they own for each type of shares over time, right? So because you can buy different things over time, coming up to your total ownership in terms of number of shares, and total ownership in terms of like ownership percentage. That's one good way to lay it out. That's kind of a primer in terms of the typical information that's on a cap table, right? So typically you're going to have on there shares, either total or per class of shares, usually issued and outstanding. Typically have details on there about options that have been granted or issued or available. Safes, convertible notes, which is a little bit of a side note, and then fully diluted shares and share prices and those things attached to them. The thing about safes and notes is that there are special cases in which case, until they convert, they don't actually own shares. So they're not going to be issued in outstanding shares. But it's important to still model and think of them at cap table because they will be shares at some future point in time. And so the basic way we handle that is we'll build a cap table and say, hey, here's the number of shares that everybody owns right now, issued and outstanding. And then we'll have another sort of column, which is, hey, here's fully diluted shares, which is if you actually converted all these unconverted notes, what would they own and what would the pro forma cap table look like at that point in time? And I'll show you an example of that in a minute. So that's the important thing. Now, converting investments usually is referring to the act of converting these convertible notes and saves into equity at the time of a future equity round. They're purchasing the same shares as the new equity round, but they're usually paying different prices because of the caps, discounts, rates, those sort of things. And again, like they usually pay a lower price, and that lower price is the reward for investing earlier and kind of bearing more risk behind it. So let's do an example, right? So all of this makes sense to a degree as in terms of the structure, but I kind of want to show an example how to do this as well. So I'm going to stop this for a second and pull open an actual kind of example. If people have kind of questions, happy to kind of answer anything now as well. You can feel free to, I can scan the chat. The Q&A also like works really, really well for answering questions. The link on the chat, it's right there. So if you look at the screen, this is the link to the spreadsheet right there. So Ari's question, I can talk about, so before we dive into the details here, a couple things. So to your question about liquidation preference, liquidation preference kind of refers to the idea that investors, when they put in money, they get kind of first claims and seniority on capital at exit. We're not going to cover exit waterfalls. That's an entirely kind of like separate thing associated with just like modeling up the cap table. Because basically you go to cap table and then you say, okay, well, at the time of exit, what do you guys already get? We're not going to talk about exit waterfalls. So we're not really going to talk about liquidation preferences as part of that. That's something I talk about in tons of other things. And actually in that cap table model I shared before, in that Foresight /cap table, cap hyphen table, there is a sheet in there which is an exit waterfall that will take inputs for like liquidation preferences and different types of preferences, all trying to do that. And I'm happy to answer any questions about that offline. We will do best practices in terms of cap table. That's a perfect thing there. Thomas's question on preferred equity. So basically, the answer to that was yes. So first off, this thing's available at the link I showed earlier. These slides are also available. And I have an example kind of sheet. There's a couple example sheets in your model. And there's also a video which kind of dives deeper into kind of one of the examples here as well. So I usually have like a bunch of videos attached to the models. So the question on preferred equity, typically you issue equity, there's usually two common methods for it, common and preferred. The major difference is preferred usually has like a liquidation preference or extra rights attached to it other than common. Usually have a first like claim on capital than common. Preferred equity has usually a liquidation preference attached to it, and usually has the right to convert into common. So in most cases, preferred equity can say, hey, in the event of an exit, you can either get your money back in terms of your liquidation preference roughly, or you can choose to convert to common and get distributions along with the common shareholders. I'm massively simplifying the range of options there. That's kind of the basic idea there. Most investors will buy preferred equity because they want more rights attached to it, more ability to, they want not necessarily control, but they want to have a first claim on their money, want their money back before the common shareholders, typically the existing kind of founders or management team or employees. But oftentimes investors will purchase common as well. Sometimes they'll purchase both. Sometimes some investors will only purchase common to be in line. So it kind of depends upon that. But that's the basic difference with kind of preferred equity. So to the question around, I don't want to go too deep into conversions, DL, but I'll talk about it Well, let me put a pin on that and come back to that when I talk about the idea of once I kind of lay the foundation in terms of like a layout cap table, then we can kind of touch on conversions in this thing. So put a pin on that for a second. If you don't mind, drop that question into the Q&A so that way I don't lose it in the chat. So this is one example of how to create a cap table, and the way I kind of laid it out here is there's this. What I typically do is, the list of investors or type of investors in rows going down the side, and then all of the relevant kind of details attached to cap table and the columns going across. And I usually start off with like a pre-financing cap table, kind of like right here. In this case, it's really simple. There's two founders. If you had more founders or people own shares, you could either group them together all as like one set of like common investors or management team, or you could input each individual shareholder. It really just comes down to like what level of detail you want to share to people and communicate to them. Oftentimes you'll have like you want to share a cap table that doesn't actually doesn't give away to everybody who looks at it what each individual person owns. So you kind of group everything together. Sometimes you will do that when you want to be able to talk to the specific employee and it's the exact amount they get. So the context and usage kind of depends upon the right level of detail kind of give to that. So usually what happens is the company in their bylaws, they set up an idea of say, hey, here's how many shares we have authorized. And of those like total shares authorized, they will issue shares to various people. And so founders will get issued shares, typically common shares. And in this case, we have kind of two co-founders. There's just imagine a simple company with just two co-founders, and they have let's just imagine that the company has issued 10 million shares, 5 million to each. The number of shares doesn't really matter. There are some very detailed legal reasons in terms of why the number of shares matters in terms of calculation, corporation tax, and those sort of things, but let's not worry about that for the moment. 10 million is usually a pretty good number. So 5 million shares kind of per. And you can see right now, so there's the number of issued. So each founder owns 50% of the company total. And so then in the next set of columns kind of coming across, what I'm creating is a pro forma cap table for the first equity round. In this case, I have two investors coming in, and I'm assuming they're buying preferred seed shares. It isn't mathematically, it is for the purpose of the cap table. It doesn't really matter whether they're buying common or preferred. The math is the same, but let's just imagine that we're purchasing kind of preferred shares. So typically I'll lay out a column for like the investment, the number of shares that are issued in this round, the total shares are issued after the round, and usually a percentage ownership. The reasons why I care about that is I want to see like how much money came in the round, how many new shares were issued, what's the total ownership, and then what's my dilution basically. And dilution is this term which I think is people use all the time, but like I think kind of fail to understand the meaning of it oftentimes. Dilution basically refers to the idea that when new money is coming in, and in this case these two investors are investing $750,000, and they're investing at an agreed upon pre-money valuation of 10 million. I have no reason why it's 10 million, just chose a number. So pre-money valuation of 10 million, I then calculate the share price. The share price here is just the pre-money valuation I laid out divided by the number of shares that are issued and outstanding prior to the round, $1 per share. So I say, okay, $750,000 coming in, total investment. Post-money valuation, which is the pre-money valuation plus the amount invested, so then $750,000 divided by the $1 per share means they're issuing $750,000 shares. If I change this pre-money valuation to say like 15 million, the share price will change effectively. The number of shares that they're gonna purchase changes as well. And so what happens here is we issue shares to the new investors, so they now get the new shares. The founders own still the same number of shares, but they have a lower ownership percentage, right? So they're diluted in that sense, and that they're diluted in the sense they own a smaller percentage of the company. At the same time, though, the total value has gone up. Now, before they didn't really have a value attached to their company. Now it actually creates a value. But as you get diluted over time, as long as you're increasing the valuation of the company, increasing the share price, your overall ownership value is hopefully going to increase, even if you're diluting your ownership percentage of the company. So that's kind of basically the basic foundations of how that works. So what happens if you issue like another round of investment? Well, let's just say now I have a second pro forma, a second equity round, or a second pro forma cap table for the next round. And I do the same thing again. So in this case, this investor is investing again, like they're taking either some portion of the pro rata. They have a new investor coming in, investing a new $1 million. So this is in case there's a total new investment in this round of 1.3. In this case, I'm saying, hey, let's just do an agreed upon valuation of, let's say, 30 million. So this price per share is a 30 million divided by that 10.5, right? So the 30 million pre-money valuation divided by the 10.5 is my price per share. Post-money valuation is what my agreed upon pre-money valuation plus new money coming in. That's post-money valuation. Number of new shares that are issued in the round is just the amount of money put in divided by the share price. And then total number of shares is new shares I purchased in this round plus what I already owned. That's simple, kind of basic structure. And then we get to the percentage issued outstanding. Now, the complication comes into this is, okay, well, what if you have safes and convertible notes, right? And so this kind of comes back to kind of DL's kind of question. What happens if you have them? Typically what you'll do is you'll have more information, right? So you'll have the same kind of pre-financing cap table, the same basic idea of a pro forma cap table. But in this case, if they're investing via notes or safes, they're getting a claim on shares, but they're not actually getting any shares at the moment. They won't get them until like the next round of financing associated with that. So typically in a cap table, you'll see something like this where you can either do it in columns for the different terms, or you could do it you could do the specific terms of investment in a separate table. Doesn't really matter right at that point. The important thing is to have the information and be able to kind of show what the terms are so you can do the calculations associated with it. So in this case, we have new money coming in at a valuation at a price, and they're not really a price per share. There's not really a pre-money valuation, right? In this case, there's caps and terms associated with the note, but you're still not setting an actual valuation. So there's no actual, you're not issuing any shares. There's no share price, nothing yet. So you'll notice in this case, the total shares and issue outstanding doesn't change. We created, it doesn't matter if this is a pre-money safe, post-money safe, convertible. The issue outstanding doesn't change at all. But what will change is fully diluted. So in the case of like fully diluted is supposed to reflect the full ownership or full value of all, if you convert everything, what will they actually own? Now, calculating fully diluted comes into the concept of conversions. And so I don't want to I can tackle questions around it. I don't get too detailed in the math in there because the right way to do it kind of varies in the situation. But in many cases, in most cases, you can, well, it varies effectively. The way you want to do it for a post-money safe versus a pre-money, if they're post-money safes or pre-money safes or notes, it varies. So DL's question of like, which converts first? Well, they don't, right? The short answer to that is actually a more nuanced answer. That is post-money safes convert first. If you have post-money safes, they are strictly written, so they will get their ownership first, and then anything else will convert after that. It's typically not common to do a bunch of different kind of structures though. Like most, if there's lawyers here who want to disagree, feel free to kind of chime in the chat, but like most companies don't like to have lots of different structures, lots of different convertibles, because it makes the math and the structure kind of hard to understand, at least outstanding at one point in time. People may issue different things over time, but you don't tend to find a lot of situations where people will do like a whole bunch of safes, then do some notes, and some post-money safes. You don't find too much of that over time. You will find examples that have companies like newer, some companies that existed prior to post-money safes have issued post-money safes, and they'll have pre-money safes outstanding. But companies try to reduce the complexities around that. So it's usually, I don't see too many situations where they're even because of the question of like which converts first, unless there is a post-money safe, and that one is a little bit clear. But the math in terms of like if there is pre-money safes and notes outstanding, well, the math how it treats the same. So it doesn't really, it's not terribly, it doesn't really kind of matter there. I can dive into some of the math around it, but well, but I want to make sure and tackle the easier questions first before I dive into that. So Mark's question, including common stock for employee pools. So the answer to that is yes. So this is like kind of a simplified example of what happens if you don't have option pools. I said at the beginning, I don't want to do too detailed about option pools, but if there was, so in this calculation of price per share, for example, in this example, if there was an option pool, then they would be included in that calculation, in that number of fully diluted shares that are used to calculate the price per share for this round. And you would include the option pool would be shares. So if you authorize an option pool, meaning basically saying, hey, we're the company, we're going to authorize shares that we can give away to employees that we're still have to hire. Typically, there's a part of you'll create a number of option pools and you'll give it to people over time. In that calculation of like that price per share, you'll include the full value of the option pool, which will include options you've already given away plus options you haven't given away yet. So you typically want to include that full pool in the calculation of that. It gets a little more detailed in terms of the calculation, the price of it, when you start thinking what's the price when you issue option pools during the round and deal with the dilutive effect of issuing the options. But I kind of have to not cover that. It's a little more kind of detailed and complicated to handle. I'm going to pause and kind of go through some questions. So I agree with Wayne. Yeah, that's a good point. Same structure is usually what people prefer, but it doesn't always happen in real life. But the good thing is that when you actually do the conversions, the math for pre-money safes and convertible notes is the same. So it doesn't matter. It doesn't really matter for different structures. There's a little bit different. Like you're going to calculate like the interest gets converted and maybe you roll it into shares, maybe it gets paid out. It's not really the math in terms of the cap table implications is really kind of the same. And the good thing about post-money safes is that if there is post-money safes to other ones, it gets a little bit cleaner because you're guaranteeing the ownership of the post-money safe. So the way that the actual conversion of post-money safe works is you convert the post-money safe first at the agreed upon terms, then you issue the new equity or handle any of those sort of conversions associated with that. So there's a staging attached to that makes it pretty clear. What's one of the nice things of post-money safes is that you math it on. It's usually kind of clear around it. So I'll go to this question. So special on cap table is the conversion of pre-post-money safes. Yes. So I have other like courses which go like much deeper into that topic, and that free cap table does do the example of how to do that. I also have like videos on how to do the conversions as well on my website. But I might, if we have time, I can pull up another example to help kind of explain some more details and show some more examples around that. I might do it actually right now. You're converting a safe that determines specific PPS. What's PPS stand for? Oh, specific price per share. Well, usually don't, right? So a safe's not going to say a price per share. It'll say like a post-money cap on the value. I mean, effectively it will, right? The safe won't say a specific PPS, price per share, but it'll say what the post-money cap is. And so then each post-money safe effectively has a price per share because you take the price that cap effectively sets like the cap of the valuation. So if it converts to the cap, you would say, okay, well, there's a 30 million, or say the cap's a 10 million post. Then you would take the number of shares that are prior. This is actually, wait, before I do that, this is much easier to actually show. Maybe we start doing math. It's much easier to do some examples. 1 second here. So here's an example. This is from this is actually from a set of examples that I use in terms of like the cap table masterclass. So, but it's just helpful to, there's just more stuff basically built into it to kind of show how a lot of stuff works. So I wanted to kind of bring this up to answer your question specifically around that price per share. So the way around the post-money cap, so post-money is an easier one to tackle, partially because it's the same example, this pre-financing cap table, and there's a pro forma cap table, and there's a pro forma cap table for a post-money safe. And so the way to do the math on this is pretty straightforward. And in YC's documents, there is if you go to the link I shared earlier, there is a PDF which says, hey, here's exactly how to calculate it. There's examples that say, here's exactly how to do it. What I'm doing here is taken directly from the materials the YC shares around us. And so the way that you basically do this is you're calculating, you have to account for the full dilutive effect of all post-money safes that are out there to use to calculate the number of shares that issued to one. So in this case, if there was, say there was no other investor here, I would say, okay, what's the dilutive effect of the note? Is basically the investment divided by the amount invested by the cap is the dilution that's created by the note. And so then I calculate the number of preferred shares are issued in the round as part of it. And then, which is basically saying, hey, how much is invested divided by something. And what's it divided by? It's divided by the price per share, which is that cap on the post-money cap of the round divided by the number of common shares that exist prior to the round. That's the share price. You divide that by 1 minus the dilution. Right? And technically, it's the total dilution of all post-money safes are converting into the round. And so that figures out what the share price is. So then you take the amount you're investing divided by the effective share price. That says the number of shares are issued. And so the way this works out is if you were an investor and you were putting in 500K into a post-money cap of 8 million, that means you're agreeing to buy 6.25% of the company. You do the math behind it, you buy 6.25% of the company. So if you go back to the situation, you have another investor coming in, the number of shares they're going to purchase is different, but the ownership stays the same. And the reason for that is, even if the caps are a different kind of caps, the reason is because in the math, you calculate the dilutive effect of each note and then the total dilution of all the post-money safes. And so back to the same calc, what I'm doing is the amount invested divided by the share price, and the share price is the cap divided by the number of shares divided by 1 minus the total dilution. And notice the example here, the formula is exactly the same for this other cap. I'm sorry, this other safe, except for the case that except for this case where except for this case that they have like a different kind of cap associated with it. So one kind of example behind it. Does that help answer your question? Let's go through more questions. So the consequences of making the valuation cap too high or too low for the founder and the investor in the safe. Well, so most of that, the consequences around that is around signaling and communication. So it's usually a bad signal if you've told earlier investors that the valuation is one thing, and then later on new investors, it comes out to be much lower, right? That usually sends the wrong, signal around execution and growth. And so it can hurt narrative of fundraising, or it can affect like a fundraising, kind of the narrative of your fundraising, your story behind it. Mathematically, it's less worrisome in the early rounds with like safes, for example. It's different for like price equity rounds. So if you have a price equity round, if you raise money at $5 per share, and later round they say, well, it's actually worth $3 per share. If investors have anti-dilution rates and preferences, that usually kind of creates a whole other set of things of bad things for a company to kind of deal with. Usually a lot of dilution. If investors have anti-dilution protections, you as the founder, you're going to get diluted because of that. But that's with price equity rounds kind of later on. Early rounds of safes, like mechanically, the way that the conversion terms are written is usually kind of, the math's not very hard to do it. The problem is you just get diluted more effectively, right? So, it's a bad thing for a founder in that side. And so most people try to stay away from creating situations from that as much as possible. So there's usually some rationalization on kind of valuation as part of it, but it happens. And it's going to happen a lot right now, because there's definitely a lot of companies that are raising it, or changing their valuations, for example. A lot of, especially like either early stage and late stage companies right now, changing valuations off of rounds. And so it creates different issues for companies based upon their stage and their capital and employees and employee incentives and stage of the company and growth of the company. But it's usually something people try to stay away from as much as possible. Other questions you may have? So I'm not going to model down rounds, partially because, so one, I do down rounds as part of like my full course. Not gonna. So the interesting thing about down rounds is that, so what a down round means, to talk us more fundamental, what a down round means is that you're raising money at a valuation is lower than what earlier investors have paid. That's effectively what a down round means. If it's like a full recap? A recap is actually easy to model because it's basically just throwing away everything from before and creating a brand new cap table. But a simple down round just means that you're raising a lower valuation. It doesn't affect the cap table too much. What it really affects is the exit waterfall, because what it effectively means is new investors are buying more money. And if an early exister owns anti-dilution protections, what it does is you're usually not issuing new shares to the investors. What you do is you're changing the conversion price on their existing shares. So what that means is that you're not giving them more shares. Like the goal of anti-dilution protection is that they actually own the same kind of the same value of their shares. And so what you do is, it doesn't change the cap table, the ownership percentage. But when you go to the point of like modeling out an exit waterfall, you have to change the conversion ratio and saying, how many shares of preferred convert to how many shares of common. And you have to use that your waterfall, your distribution of proceeds as part of calculations there. But it's not really going to affect the cap table in the same way. And to Jeff's question, is people don't usually predict down rounds. It's usually not something, most like forecasts are, people will do down rounds in terms of like a scenario analysis around it. But most times people are just going to say, hey, this is the world of up only. This is the world of like up and to the right. People aren't going to forecast. You're not usually going to build a forecast for a down round unless that's specifically what's happening. And when you do that, you start reading legal docs or associated with the rounds of money you raised to see how to do it. But it impacts the exit waterfall more than it impacts the cap table in terms of modeling a down round. But that is something I do kind of cover, I tend to cover that in terms of the course. Some of you probably where my goal today was to cover, a good set of material around cap tables, those things. I do have a course which dives into all these things in much more detail. You can find out more about it here. As part of that, I do down rounds. Yes. As part of it, we do anti-dilution effect as part of, I think, the impact of anti-dilution is in session 2. And then in the class and exit waterfalls, we do all the stuff in terms of how the conversion ratio changes, how it impacts things as part of that. recaps are simple. A recap, you throw away the existing cap table and you put a new one. So, doesn't really, it's it's pretty easy to do. And the post money safe example, price per share. Yes. So in a post money safe, what you're basically doing is you're the waterfalls is one of, so we're not doing waterfalls in the class in this session today, but waterfalls is definitely part of the one of the last sessions in the course. I think it's like session 5. I think it's session 5 is the part of it. So back to the post money safe question. I see somebody raising their hand. If you have a question, you put in the Q&A or the chat. The post money safe example. So basically, the post money safe has a cap associated with it. You can think of the cap as evaluation. So if there's just one post money safe, you would say, okay, well, you say the post money cap divided by the number of shares that issued prior to converting the safe. So say $30 million, well, say $20 million cap and 10 million shares outstanding. So the price per share would be 2. But you have to adjust for the dilution. So, right, so it's basically like the act of issuing the new shares creates some dilution to it. So remember, you have to have the safe has, if the safe's buying in that example 6.25%, you can't just issue 6.25%. You have to account for that dilution effect as well. So that's why you calculate the share price as that cap divided by the number of shares divided by 1 minus the dilution, that dilutive effect you calculated, and that's the price per share. And then it's the amount invested divided by that kind of share price, calculated on the number of shares. So the answer is it's not shares you got based on safe divided by total investment. Shares you got. So the safe defines the terms for the safe. Doesn't say how many shares you get. It says it's your way to calculate the share price effectively. So the amount you invest divided by the share price. It will vary depending upon the actual kind of terms. It will vary by how many other safes you have, what other safes are out there, the caps in their safes are, the value, if there's a cap or a discount on the safe, what the actual rounds being raised at. So like there's a whole bunch of other variables that in there that will vary based upon that. So no, it's total investment divided by, so back to Mark's questions, total investment divided by share price. Basically how it works. Easier question to answer with math sometimes, but hopefully that kind of helped understand that a bit. So Craig's question. So so the answer is like yes, right? I cover that in terms of the course itself. The way I try to approach this in general is I want people to understand the mechanics of it and then understand how to do the storytelling outside of that, right? Because honestly, there's lots of people out there going to tell you things about how to do the narrative parts of it, but it's the practicalities of the mechanics part is something that's actually kind of really hard to do in a lot of cases. And so the way you want to tell a story around the growth is going to depend a lot by situation, right? So the context of how to tell it's going to vary by the situation, right? Some companies if you raise lots of money early on, some don't need to raise money early on. Some founders can raise a high valuation early on, some founders can't. So like it varies in terms of how you want to appropriately kind of tell a story around it. But as part of the course, we do in part of like conversations, answering questions, or people ask me questions about this stuff, we dive into stuff all the time. And so we do talk about like, okay, well, how much shares should you give, founders? How much of an option pool should you create for in each individual round? How much money should you raise? we dive into the context around it and the implications of each one of those on the dilution, because that kind of comes out from it. So that's a part of it. But it's, you know, when I worked in venture, when I worked as a VC, you know, I did all the narrative stuff, right? So I had all the narrative and all that kind of part to it. But it really wasn't until I, you know, left that and started doing, you know, Foresight full time, until I actually really understood the math and kind of much kind of deeper kind of context to it. So now I focus on the math and try to use that as a way to come back into kind of the narrative around it. Alex's question is this cap table class kicks off next week. Before I go, the major thing I'll say is there's, in space, you can tell by the range of kind of questions that people kind of ask from it. There's many different ways to take this. And so there's a lot of kind of complications that dig into how to handle different situations, you know, how to do conversions and how to understand exit waterfalls and how to calculate all these things associated with it. And even to point of like, even like crypto tokens and how to think that kind of structures. If you have questions about stuff, you can always ask. I'm happy to answer questions around anything associated with this topic at any point in time. So feel free to ask for any clarifications or questions or things you want anytime. You know, my goal with the course itself is basically to just help people kind of understand it in you know, deeper context. If you want to like really learn how to do everything themselves. At the same time, I recognize not everybody wants to do that. And so if you just have one-off questions about those topics, you can feel free to ask anytime. I'm always happy to kind of answer questions. And you know, that free kind of cap table things out there is intended to be like a free, it is intended to be like an educational resource to understand kind of how this stuff works. And I often help people kind of use it for specific kind of purposes in terms of like modeling rounds or doing scenario plannings around rounds. But at the same time, if you just have questions, you can always kind of ask any point in time. I want to really thank everyone for coming today. I really kind of appreciate everyone taking some time out of the day to show up. And I'm looking forward to doing more of these later on. So expect to hear more about them. Thanks.